Friday, August 7th. First Friday every month is payroll day. Payrolls are the most important single data we get every month. We got another couple 100,000 jobs, nothing exciting, no increase in incomes, but this and the payroll data that we're going to get right after Labor Day, the odds that the Fed finally comes up off zero in September are now very high, and mortgage rates fell. What's up with that? We're going to be talking a lot in the years ahead about the yield curve, and all that is bond marketese for the relationship between short-term rates and long-term rates. It was a lot easier to explain on camera than in the copy that's next to this. The Fed controls the overnight cost of money. Long-term rates move with the marketplace. Now, the Fed has fooled around with long-term rates in quantitative easing by buying a lot of mortgages and bonds, but Fed, market, mortgages, Fed. Ordinarily, if we saw a pattern of the kind we're seeing where the Fed is about to do this, ordinarily, especially at the beginning of it, these go up too. The whole thing moves up in one piece. And sometimes these guys, long-term money, get so scared of this that they do this, which is what everybody in the real estate business is worried about. The Fed says it's coming. How hair-raising does it get out here? Typically, at the end of Fed cycles, the signal that we're going to have a recession is when the yield curve starts to flatten out. Fed keeps coming, long bonds, nothing happens. The clinching signal that the Fed has overdone it in my lifetime, longer by the hour, is the Fed's still coming and all of a sudden there's a bond rally and long-term rates start to fall. It's just what's happened since the middle of July. Rates haven't come down a lot, but mortgage money has come down from close to 4.25 to close to 4. It's still a big deal. The 10-year Treasury note, which defines everything, has come down from 245 to today 217. It's come down most of a half a percentage point in just 6 weeks. The signal embedded in that move is not that we're about to have a recession. There are three other things that are happening that cause global pools of money to want to buy long-term American bonds, even though they don't pay much of anything. First reason is that the dollar is getting stronger and every other currency is getting weaker. So if I buy a U.S. Treasury that's only paying 217, 220, I also get the yield from the appreciation of the dollar versus whatever my currency is. The second thing going on is the world's a really uncertain place at the moment. Now, Europe is entirely gone on vacation in August, so they can't cause any trouble, not at the beach. China's a mess. The hyper-controlling party in China, theoretically a meritocracy, has it pretty badly screwed up. And it looks as though, China may be in a slowdown deeper than anybody anticipated and unable to get out of it. U.S. Treasuries are the world's safest investment, so money comes in addition to the dollar flow. The third piece I alluded to before. The Fed, in the depth of trouble in 2009, began to buy both long-term Treasury bonds. It owns about $2 trillion of them now, and also bought $1.5 trillion worth of Fannie Mae, Freddie Mac, MBS, mortgage-backed securities. Every time one of those matures, the Fed buys another one. The Fed is not even letting its holdings run off as they pay off. So when you refinance your house, a Fed trader later that month has to enter the market to buy an equivalent amount of new MBS. Now that puts downward pressure out here. All three of those things put downward pressure out here, and I think that's what's in play. There may come some moment when we'll worry about inflation, we'll worry about an overheating economy, and then we'll worry about a spike in long-term interest rates. But that isn't even remotely on the horizon. So we sit here, Fed's coming, and we're just above 4%, and housing recovery. Good weekend.